Hi, welcome to the It's Your Money and It's Your Estate Spring 2025 workshop series, brought to you by our 501c3 nonprofit organization, Financial and Estate Literacy. Our mission is to empower you to take control of your finances, your estate, and your charitable giving decisions. For the past 25 years, our founder, Peter Kote, as well as our entire team, have been providing these free, unbiased, and accessible 6-week workshops all over Orange County, California, as well as online, to help you make informed decisions that align with your unique needs and values. Now, let's start the program. This webinar is the 5th session of the It's Your Estate 6-week program. The topic of the day is retirement asset planning. Our moderator is Peter Coates. Our guest speaker is Michael Simon. And this webinar is brought to you by American Heart Association. Enjoy the workshop.
Good morning, Michael.
Good morning.
Hey, let's go through your Ask First form quickly.
Okay, would you like me to bring it up?
Yeah, please. Mike, how long have you been doing estate planning?
Well, I've been in this industry. It will be 25 years this year.
God, and you don't look a day over 30. I always say that you're one of the best in talking about these plans that we're going to talk about today. I know you're going to go. I want you to talk about the why that is, and I don't know if you want to do that now or you want to do that later.
I've got a slide to address that topic. So we want to run through the Ask First, and I'll get to that important topic soon.
Okay. Let's see. I don't see your Ask First yet on the screen. And we'll go there. While you're doing that, I'm going to ask you to do a couple of things while you're trying to figure that out.
Okay. And Eugene, if you want to jump in, my screen is shared. So
yeah, we see the PowerPoint presentation. Let me see. I could share it if you'd like.
Just so that, by the way, every presenter's Ask First form is on our website, so you can get at it. Eugene, we really don't need it. Let me just go through it. We know that you're licensed here in the state of California. You don't have any other license besides your law degree. How do you charge your clients, Michael?
well, before I talk about how I specifically charge, I want to throw two concepts out there. And the first is that estate planning isn't really the place where you want to shop for the lowest price. This is a really important area, and generally you get what you pay for. Secondarily, as far as pricing, be careful that you don't get sort of a bait and switch and somebody says, well, the estate or my trust it'll cost you $1,000 to do a trust, but don't forget, it's not just the trust. There may be additional charges for wills, powers of attorney, and healthcare directives, deeds, and all those other things. So don't fall for the lower price. So the way that I charge is either by the hour or on a flat fee. And so let me address those two ways I charge. The first is on a flat fee basis, we of course do your will, your trust, your power of attorney, healthcare directive, but we try to pack a lot of value in this. And so in that package, we also do a deed for your primary residence, including doing the property tax form so we don't mess up your property taxes. But we also do a lot of other important things, including what we're going to talk about today, and that's beneficiary designations for retirement and insurance products. And as you'll see today, that's a really important part of estate planning, which we'll talk about in a second, that often gets overlooked. But in addition to that, we like to spend a lot of time with our clients. I spend an hour or 2 hours with each of my clients guiding them with my 25 years of experience to try to help them make decisions about the design of their estate plan. And when the documents are finally finished, instead of just sort of cutting a corner and mailing them out to you, I like to have you come back in this program, this flat fee program. I page the documents. I supervise the signing because we're afraid if we mail them out, there's notarization, witnessing, initialing. We don't want that to get messed up and those documents not available when you need them most. So again, we have you come back in, and all of this takes a lot of extra time, but we're not trying to save time. We're trying to get the highest quality documents. So with all that said, the flat fee pricing for everything, including notarizations and the documents, attorney time, is about $3,900 to $4,500 for a married couple, about $2,900 to $3,500 for a single individual. Now, the last thing I want to put in here is that not everybody can do the flat fee pricing, and that's where we charge by the hour. We have circumstances where we have complicated blended families, we're disinheriting children, we're planning for estate taxes, and in those projects, we don't know how long it's going to take. So in that case, we charge by the hour, and my hourly rate is $475 an hour.
Do you provide any time? Let's say I'm not sure, Michael, I want to, you're the guy for me. Do you give any time either in person or by phone for a chat to see what I need?
For sure. And I'm happy to do an introductory complimentary consultation. It's usually 15 to 20 minutes on the phone. We do it over Zoom, so happy to provide that for you.
That's wonderful, because the only thing you have is time. So many attorneys don't provide that. So really appreciate that. Your screen is still on the retirement account planning. So I don't know if that's my screen or, hey,
I'll share one more time to make sure that.
Yeah, it seems to the screen has all your side slides on the side. I don't know why that is. There's your ask first.
Okay, perfect.
We know it's there. By the way, you don't offer any insurance products or securities or sell annuities on the side?
That's right. I don't participate in that.
Yeah. It's always, seems like a silly question, but it's important. And let's see, can we get into the PowerPoint, or is that?
Sure, I'm ready to go. Are we ready?
Yep, we're ready. Here we go.
Well, let me first say I'm very excited to be here and share this information, but honestly, I'm more excited that you as the participants are here because this program is titled Retirement Account Planning, and it's probably the most boring title that we could conceive of, and we're always afraid when we turn this Zoom on that no one's going to be here. So I'm glad that you're here. I'm going to make it worth your while. This has a lot of really important information, really current information, and I think everybody's going to get something out of it. As far as questions, the chat will be open and we can.
The Q&A will be open, Michael.
Yep. And then as far as at the end of the presentation, I've allotted some more time. We may have time to open the mic and we can ask questions directly. And please don't be shy. I know attorneys don't say this very often, but I'll answer all your questions and I won't charge anyone. So take advantage of it. Now, as far as the presentation today, I've got a slide up about what we're going to cover, and we are going to cover what the latest rules are for these retirement accounts. And that includes the new Secure Act, the Secure Act 2.0, as well as some really important legislation, regulations, and notices that are just a few months old from last year. We are also going to talk during this presentation about how we calculate your required minimum distributions. That's your RMD. And if you don't know how to calculate your RMD, perfect, you're in the right place because I'm going to cover it and show you how to do it today. We are also going to talk about the important topic of how we choose beneficiaries for these retirement accounts. We're going to talk about whether the stretch is dead or alive. And if you don't know whether the stretch is dead or alive, again, you're in the right place because I'm going to tell you. And then we're also going to talk about the very interesting topic of Roth IRAs, but we're going to save that to the end because, again, they have a separate set of rules. Now, before we get into sort of the substantive material, I wanted to cover some vocabulary. And when we say retirement accounts for the first part of this presentation, I'm talking about your IRAs, your 401ks, your 403bs, 457 plans, etc. All of those accounts are what we call retirement accounts. Now, because the Roths have a different set of rules, I'm saving them for the end. Now, for these retirement accounts, and again, your IRAs and 403bs, etc., we can make contributions to these accounts, and there's a real important benefit. And that benefit is that the contributions that you put into these accounts, you get an immediate tax benefit. And what do I mean by that? If you have income of $50,000 from a job, and then you put $5,000 into an IRA account, well, we get an immediate $5,000 income tax break on that money. So the contributions are important, and they get to grow in a tax-deferred environment, meaning that the money that we get to put in here, we get to avoid paying every year the income tax and the capital gains on it. So it has this potential compounding effect that we really can't get in any other type of investment. Now, with all this said, Pete, do you want to take a guess at how much money is in all of these retirement accounts?
I would say maybe $1 trillion.
Okay.
That's a
Close.
guess.
Close by a factor of 44. There is $44 trillion in these various retirement accounts. So a lot of money.
44 trillion.
44 trillion.
Jeez.
Now, what about Uncle Sam and all this? I just told you that there is trillions of dollars of untaxed money. We call that pre-tax dollars because remember, the money that you've put in there, you got an immediate tax break on the contribution, plus all of the growth has yet to be taxed. And so my question sort of rhetorically is, do you think the IRS wants a piece of this action? And of course they do. But many clients don't realize that they still want a piece of the action and get their tax even after you've passed away and left these retirement accounts to beneficiaries. And in fact, you'll soon learn because of the Secure Act, the IRS is going to get their money much faster than we ever expected. And this point down here at the end of the slide, Pete, is one of the most important ones I want to communicate to everyone, is that these retirement accounts are not tax-free. They are tax-deferred. And it is important that people understand that generally, and there are some exceptions, the IRS is going to get the tax on this money regardless of what happens, even if you pass away.
You know, it's surprising to me, Mike, that we're in this whole discussion right now in the country because the present tax act is going to end after the end of this year. And this is not being discussed.
Yes. With these trillions of dollars at stake, it's an important topic.
Yeah. Amazing.
Now, this is the part that you sort of wanted to reference at the beginning, Pete, is that before this is the last slide, and I'll get into the material, is that this is a really important topic. And sometimes retirement accounts are our client's largest asset, but it is often missed or overlooked in the estate planning process. People get focused on doing their wills, their trusts, their powers of attorney, and healthcare directive, and they forget about what might be their main asset, and those are the retirement accounts. And we take a special tact on this because we know how important it is, but not every estate planning attorney does that because this is something that you have to do with your financial institution. So we spend a lot of extra time making sure that we get these taken care of. And the important takeaway from this slide is that when you do your estate planning, there is what I call a fifth pillar. After all your main documents, you have to make sure your beneficiary designations are also addressed.
Yeah, most attorneys will hand the clients a letter and say, take this letter to the bank or to your brokerage firm and figure it out. I mean, they explain it, but from my point of view, I mean, the way it should be done is exactly the way you do it, Michael.
That's right. And what we do is we ask our clients to provide us with their blank beneficiary designation forms, which I'm going to explain in detail in a few minutes. And we complete those for them so that we can ensure that it is done properly and consistently across all the accounts.
Yeah, I don't think people understand the importance of it, but we'll get into that as we go through the program today.
Okay, well, let's start, and I'm going to start about talking about retirement accounts and how these accounts are treated during your lifetime. So again, these are your IRAs and 401ks and 403bs. How are these accounts treated during lifetime? And the first rule I want to talk about lifetime treatment of these accounts is that if you decide to withdraw money from these retirement accounts prior to the age of 59 and a half, unfortunately, it is subject to something we call an early withdrawal penalty. And that penalty combined, federal and California, is 12.5%. But remember, you still haven't paid taxes on this money. So the 12.5% is just the penalty. We still have to pay our regular income tax. And let's just say you're at 30% federal, 10% state, that's 40%. Then you add the 12.5% penalty and we're over 50%. Now, when you make an early withdrawal, you get a 1099-R in the mail. You have to report that on your tax return. Some good news is that there are many, many exceptions to this early withdrawal penalty. And under the Secure Act 2.0, they added a lot of extra penalties, including waivers for penalties for domestic violence, terminal illness, and even qualified long-term care expenses. So before you pay the penalty, make sure you talk to your tax advisor and see if you don't fall into one of the exceptions. Now, after you turn 59 and a half, but before the age of 73, and no, that's not a typo, it's not 70 and a half or 72, which I'll explain in just a minute, you may, but you are not required to take money out of these accounts. Now, the good news is because you're over 59 and a half, we don't have to have any early withdrawal penalties, but you do still have to pay tax. You get that same old 1099-R in the mail and have to record the income on your tax return. Where it starts to get interesting is when you turn 73. And again, not a typo, it's not 70 and a half or 72 anymore. But at that point, age 73, we're required to take money out of the accounts. Now, starting in 2023, they changed the required beginning date, the date we have to start our RMDs, to age 73, and that's eventually going to increase all the way up to age 75. So our starting date is going to change. Now, this whole process where the IRS requires us to take money out, again, is referred as RMD, required minimum distributions. Because you're over the age of 59 and a half, there are no penalties, but again, you still have to pay the income tax on the money. And I'm going to show you how all this RMD stuff works right now, but I wanted just to give you the basic idea, and that is this. The IRS is simply saying that you have been able to defer the tax on this money long enough. And now that you are age 73, we want you to take a little bit of money out, a required distribution every year for one purpose and one purpose only, and that's so that the IRS can collect the taxes. This whole thing is about getting a little money from you out of your retirement account. Now, as I mentioned, everybody generally starts at age 73. There are some exceptions to that, but most of us start the required minimum distributions at the age of 73. Every year, we have to complete our required minimum distributions before December 31st of each year with, of course, another exception, and that exception is the first year rule. And our first year rule says in the year you turn 73, if you want, you can wait until April 1st of the following year to take your first distribution. But I always warn my clients about this, that it is a bit of a tax trap, because what happens is, if, for example, if you turn 73 this year and you decide to delay your distribution until April 1st of 2026, that doesn't excuse your 2026 distribution. And what ends up happening is you have two distributions in the same year, your 2025 and your 2026. This will usually push your income up, perhaps into a higher tax bracket. It could cause higher taxation of Social Security. So be careful, although this is available, most of my clients prefer to take their 25 distribution in the same year and then take the distribution separately in the second year and avoid the double distribution. Does that make sense, Pete?
Yes, it does.
All right.
In fact, Do you, in the future, I was thinking that maybe the putting in the income tax rates would be helpful to individuals to actually kind of go through it. But it's really important. Can you take your RMD anytime during the year? Is it, in other words, on January 1st, can you take your RMD?
Absolutely. And
Middle of the year, end of the year, makes no difference.
makes no difference as long as it's out by December 31st.
Okay.
Okay. Now, continuing on with required minimum distributions, you can always take more than the minimum, and we'll talk about that in just a minute, but it doesn't unfortunately give you any credit. So if you have a $5,000 RMD requirement and you take out 10, it doesn't carry forward. So unfortunately, that isn't a plan that will work. Also, to let you know how serious they are about these RMDs is that this penalty for not following the rules here used to be 50%. They, under Secure Act 2.0 last year, they reduced that penalty to 25%. That's still a hefty number. And it can even be reduced farther down to a 10% penalty if you correct things in a timely manner. The point of all this is that we want to follow the rules and we don't want to get subject to any of these penalties. So in calculating your RMDs and making sure we don't run into any of these penalties, the good news is that most banks and brokerage firms will send you a letter starting the year you turn 73 and thereafter telling you what they think your RMD should be. The good news is that you can easily calculate this yourself. You can check the bank or the brokerage firm's work, and there can be other reasons why you want to see the calculation yourself. Now, you do have to redo this calculation every year, but again, it's really easy, and I want to show you how easy this is. This right here is our RMD calculation, and all you do is take the prior year balance on your retirement account of December 31st, divided by a factor or a divisor that is available from an IRS table, which I'll show you in a second. You divide those two numbers together, and that's your RMD. Let me show you how it works. This is part of what we call the uniform table. I'll talk about the tables a little bit more in just a second, but the uniform table is what most of us use. We simply find our age on this uniform table as our divisor. And so I'm going to do a hypothetical that saying that we're turning 73 this year. And as you can see, the divisor is 26.5. With that, I'm going to pretend I have an IRA account that has a December 31st, 2024 balance. Again, last year's ending balance. I take that, I plug it in, I take my factor from the table, and that gets us our RMD of $3,773.58. That's all it is. It's just two numbers divided together. Now, in this slide right here, what I've done is I've taken more of the uniform table and I've added another column, which I call a withdrawal rate percentage. And what I've done is I've taken the divisor numbers and created them into a percentage so that you can see what the IRS is really asking you to do for a required amount to be taken out. So as you can see in age 73, we had the divisor of 26.5, and that only equates to 3.78%. So the IRS isn't asking you to take out a lot. In fact, these numbers are pretty generous compared to the old numbers, which were prior to 2002. A lot steeper percentages and divisors. And so these are pretty tame numbers. In fact, I'll jump to age 80. 4.96% for an 80-year-old. I know the market's been volatile lately, but having said that, in a normal year, you might earn more than 5% in a portfolio. And so even after taking your distribution for the year, you might have more in your retirement account than you did before. So pretty generous. And just to give you an idea, these divisor numbers, quite frankly, are your life expectancy. And that's how long the IRS thinks you're going to live. As you can see, Pete, if you make it to 100, you still got 6.4 more years to live.
I hope to be doing the program by then. I hope you're around.
All right, a couple more things about these tables. Those tables, again, are our life expectancy divisors. As I mentioned, everybody basically uses the uniform table. There are a couple of exceptions. One exception we run into somewhat frequently is that if a beneficiary is more than, a spouse beneficiary, excuse me, is more than 10 years younger, you do use a different table, something called a joint life expectancy table. But for most of us, we use the uniform table. This uniform table, of course, is in this handout, which is downloadable off the website. And it is also available on the 590B from the IRS. So you can just Google 590B and you'll get the current updated tables. There were some changes, very minute, in 2022. So when you pull up a table to look at this, make sure you're using a table, which is the most recent table, effective January 1st of 2022. Now, one little handy rule about RMDs is that if you have more than one IRA, you can calculate the RMD separately and take it out of only one IRA account. Unfortunately, this rule only works for IRA accounts, so I can't involve 403Bs and 401Ks. But in a hypothetical, if you had two IRA accounts, for example, and one was invested in investments that you didn't want to disturb and the other one had cash, well, what you could do is calculate your two RMDs separately, combine the two into a single cumulative number, and take it all out of the one account with cash so we don't disturb the investments, and that will count for your RMD and cover both accounts. So kind of a handy rule to watch out for. Now, continuing with rules during life, the next topic I want everyone to know about is the important topic of qualified charitable distributions. There's a rule called the QCD, or Qualified Charitable Distribution Rule, and it allows taxpayers to exclude the income that they pull out of from their IRA accounts that go directly to a charity. Now, this rule is now permanent. It has a kind of a torrid history of being expiring and then being put back in the law and then taking back out. They have now made it permanent as tax law can be. And it's a really important rule because under the current tax law and the one that's proposed to be extended, this rule can be very handy. And let me explain why. So the best way to understand why this qualified charitable distribution rule is important is to understand how it worked when we didn't have the rule. And when we didn't have the rule, what would happen is that if you wanted to make a gift to a charity out of using an IRA funds, you would pull the money out of the IRA, and that money would count on your tax return in something we call your adjusted gross income. And then the hope, of course, was that once you turned around and gave that money to the charity, you would have an offsetting charitable deduction. Unfortunately, it doesn't always work that way. And if I drop down into the issues of things that were problems before we had this rule, the first problem is that many taxpayers didn't get the corresponding charitable deduction. As many of you know, when we file our tax returns, we usually take either an itemized deduction or a standard deduction. And under the current tax law, they've made the standard deduction so large that most of us don't itemize anymore. And when we don't itemize, we don't get any charitable deduction. So without this rule, it is possible that you can count the money that comes from the IRA and then not get the corresponding charitable deduction. In addition to that, even if we get the deduction, it still increased our AGI and messed up things like taxability of Social Security, increasing Medicare premiums, and other deductions that were attached to our AGI. You guys don't have to worry about all that because we have now the qualified charitable distribution rule, which eliminates all those problems because the distributions you take that you give to charity get excluded from your tax return and not included in your AGI. But get this, even though that's the case, the distribution, even though it's excluded from your tax return from your income, it still counts towards your required minimum distribution. So it's kind of an amazing deal. And if any of you are writing a check at the end of the year, for example, to the American Heart Association for $1,000 out of your bank account, why not do it this way? Why not just pull it out of your IRA? Again, the distribution will be excluded from income, and if you have a required minimum distribution, it will satisfy it partially or fully. So a great deal. Any comments on that one, Pete?
Yeah, it's if you donate to a charity and you're 70 and a half and have an IRA account, there's no reason not to do it from your IRA account. That's one. Two is that the QCD is now available from most brokerage firms now understand it, and the check just needs to be written to the charity. So make sure of that. You can have the check sent to your home and you can deliver it to the charity as well, so long as it's made payable to the charity. So it's a great deal. I just read the other day that 90% of individuals over the age of 65 are doing the standard deduction.
Yeah.
So if you're doing the standard deduction, make it a gift to charity does not give you any tax benefits.
Right. Okay. Well, and thanks for those comments. And so you understand the rules to do this. There is a limitation on the amount that you can give to a charity in 1 year. This is indexed to inflation. The current 2025 limit is 108,000. So you can't do more than that, but you can do $100. You can do $500. It doesn't make any difference as long as you don't exceed the $108,000 limitation. You do have to be 70 and a half years old. And this is a little confusing, not 73, but you can start this at 70 and a half. Now, the distributions, as Pete mentioned, do have to go directly to the charities. You can take possession of the check and deliver it yourself, and as long as it's made out to the charity. We've had some issues.
The last point that you have under here um, is I don't think it's wise to do a charitable remainder trust for a small amount, such as the 54,000. But what do you think of the charitable gift annuity
Yeah,
idea?
so this last point is that these rules allow you to make a qualified charitable distribution from your IRA. Instead of giving it outright to the charity, you can do what are called split interest gifts, charitable remainder trust, or charitable gift annuities. Now, Pete's point is valid that we probably don't want to set up and have the expense of doing a full separate remainder trust to support a $50,000 gift, but the charitable gift annuity is kind of a nice idea in that you give the 50 up to $54,000 to the charity, and then you get an income stream back. Now, this 54,000, we wish it was a larger number, but it is indexed to inflation, and it is going up slightly every year, so it's certainly a worthwhile thing to investigate.
Yeah, and remember for the gift annuity rates, you're getting up to 6, 7, and 8% once you're over 70 years old. So something to take a look at.
Definitely. Okay, well, that takes us to the end of the rules during lifetime for all of these retirement accounts. The next part is choosing beneficiaries and the rules for these accounts after you, as the account holder, have passed away. Now, they don't make it easy in this area, and I know you're all at home. Hopefully, turn on the coffee maker and take a shot
I'm going to get some more coffee, Mike.
So the IRS is this is a complicated area, and you'll see, and hopefully don't lose you here because again, the IRS makes this pretty complicated. And what I've done here is I have taken what I call these concepts, and there are 5 of them that I want to go over before we get into how we treat these accounts and choosing beneficiaries. And I think if you understand these 5 rules or these 5 concepts, you'll have a better understanding of these complicated rules that the IRS has put on us. Now, the first concept that I want to cover is that during your lifetime, you get to pick beneficiaries for these retirement accounts by completing something we call a beneficiary designation form. And that form is available from the institution that holds your retirement account. That might be your work, it might be your bank, it might be a brokerage firm. And they all have these forms that we fill out. Now, the good news is by completing one of these beneficiary designation forms is that the completion of this is a contract to pay on death. So in effect, it's a probate avoidance tool because the directions of what's to happen to this account will be a contract you have with that with your work, your bank, your brokerage firm, etc. Now, the good news is that we can change these beneficiary designations anytime we want to. There used to be some old rules that there were limitations about when you could change them, and that isn't the case anymore. The latest one that is filed with your bank or brokerage firm is the one that controls what happens to these accounts. And with that said, this point right here, the beneficiary designation form controls, is one of the most important things I want to communicate to you today, because people have a misconception that because they did their trust or their will, somehow their retirement accounts have been taken care of. And that isn't correct. Without filling out one of these forms, we have a real problem. In fact, filling out one of these forms supersedes your will and trust. So you could have your IRA account designated to a friend or a relative, and you could have a trust designated elsewhere, and it doesn't matter. The beneficiary designation form will control what happens to that retirement account. So it's important, and that's why we were saying it's the fifth pillar of doing an estate plan. You've got to do your trust, will, power of attorney, healthcare directive, but don't forget to fill out these forms. And again, they are sometimes missed or overlooked. The second concept in this area is after you have passed away as the owner of these retirement accounts, a designated beneficiary can still continue to defer the income tax on this money until it is eventually withdrawn or distributed. We're going to talk a lot about that in just a second. So the third concept is that the IRS still wants their share, even though you've passed away and left it to beneficiary, and they require our named beneficiary to withdraw the money over a certain period of time and in a certain manner. For again, just like when you were alive, the IRS wants to collect their taxes. So it's important to realize that these accounts are still going to be subject to taxation. Now, the fourth concept is that from a tax standpoint, it would be preferred that if our beneficiaries avoid taking all of the money from these retirement accounts out in a lump sum, because first, they will lose any potential tax deferral that they have, but they also might push them into the highest tax bracket. Again, if we're doing the distribution and we take it all out in 1 year, that all goes on the same tax bracket for the same year. Now, the fifth concept is that with all of these other concepts in mind, the strategy would be to try to have our beneficiaries' withdrawal period, the time they have to withdraw the money, to make it as long as possible. And before the Secure Act, we could do something we called stretching your retirement account. And we could create decades upon decades of tax-deferred growth and really could turn children and grandchildren into millionaires because of this quote-unquote stretch. Well, the IRS kind of caught up with us under the Secure Act. And under the Secure Act, starting in December 31st of 2019, they killed the stretch. And basically, the Secure Act provided that everybody, with some exceptions, only has 10 years now to keep these retirement accounts open after you've passed away. I'm going to talk about more of that in a moment, but there are exceptions to this general 10-year rule. So again, everybody's got 10 years except for some special beneficiaries we call eligible designated beneficiaries. And if you don't have enough acronyms, we call them EDBs. Now, these EDBs, these special higher class beneficiaries, get special treatment. Those would be surviving spouses, children who've not reached the age of majority, and that's under the IRS code that or regulations, that's age 21. We also have eligible designated beneficiaries, can be a disabled or chronically ill individual, or individuals who are not more than 10 years younger. That set of special beneficiaries are not subject to the 10-year rule, but everybody else only has 10 years. Now, to make things even more complicated, in the IRS final regulations of more than 200 pages about how we treat these accounts after you've passed away, if a designated beneficiary is not one of the special eligible designated beneficiaries, they added another layer of complication. As I mentioned, again, if you're not one of those special beneficiaries, everybody has the 10-year rule. But even though everybody commented that this was a bad idea, the IRS and the final regulations settled on this special rule. which says during that 10-year period where a beneficiary is withdrawing money, if the owner dies before they have started their own required minimum distributions, meaning that you died before the age of 73, during that 10-year period, a beneficiary can take the money out in any increments they want to as long as it's emptied at the 10th year. But to make things fun for everybody else, if you die after age 73, you as the owner, then what it says is that everybody's got the 10-year rule, but the beneficiaries have their own required distribution based on their own life expectancy during that 10-year period. In other words, they have the 10-year rule and have to take a little bit out every single year. Massively confusing, so confusing that the IRS kind of threw the towel in this notice 2024-35, which says, I know nobody understood this, so you are excused from making a mistake and not doing these distributions for 20, 21, 22, 23, and 24. And if you didn't do this and follow these rules, even though you inherited a retirement account, no penalties, everything is waived. But starting this year, no more breaks. Everybody has to follow these new final rules.
Mike, before we go into the concepts, I'm married and my spouse is getting dementia and needs or has a stroke or something causing them to not be able to withdraw monies at the time. I, as a spouse, can I go to the bank or the brokerage firm and ask them to do whatever?
Fortunately, Pete, the answer is no. So these individual accounts are in the owner's name, and our spouses do not have access to them. And with that in mind, even though we have these required rules, you may run afoul of these rules because a spouse has dementia or is some way unable to access the account themselves. And the way that we solve that is with something called a power of attorney. And the power of attorney, if you were married, you would likely have your spouse as what we call your attorney in fact. We would provide that to the institution that holds this retirement account and quote unquote sort of save the day, because the spouse would then be able to follow the rules and make these required distributions.
So make sure that your power of attorney, your durable power of attorney, is accepted by the institution before you have any issues or problems.
That's good advice. So with all these rules and concepts in mind, you can see now how important it is and how much thought needs to be about choosing beneficiaries and selecting who will be on that beneficiary designation form. And that's what we're going to talk about now. We're going to talk about the options for filling out that beneficiary designation form and choosing who will be on that form. Now, I've broken this down into 5 different, I'm going to say, categories. First is spouses. Second is children, grandchildren, or other adults. Another category might be naming a trust. Another category might be naming a charity. And the fifth category, would be maybe some combination of all the above. So let me go through the advantages and disadvantages to help you choose beneficiaries for your beneficiary designation form. Now, the first category that I want to talk about is an interesting category for those of us who are married, because we can name our spouse as the beneficiary of our IRA account, and it has many interesting benefits. One is that if we choose a spouse on a beneficiary designation form to be our primary beneficiary and we pass away, the money becomes immediately available to that spouse. Secondarily, because they are an eligible designated beneficiary, they don't have the 10-year rule limitation because of the Secure Act. And our spouses have a special rule, unlike anyone else. We call it a spousal rollover rule or a spousal rollover option, that spouses get special treatment. And I have a slide here that kind of explains how a spousal rollover might work. So for example, let's say that you have an IRA account and you've filled out your beneficiary designation form and you've appointed your spouse as your primary beneficiary. And unfortunately, you pass away. our spouse, unlike any other beneficiary, can create a brand new IRA in his or her name, and they can move all of your assets into that new IRA, and our surviving spouse is treated as if they had owned that account from the very beginning. What does that mean? Well, it means that if your spouse is younger, our required minimum distributions are based on our surviving spouse's age. Our surviving spouse can pick new beneficiaries, younger beneficiaries, and create more future tax deferred growth. And the Supreme Court a number of years ago also said that when you do a spousal rollover this way, we get some extra creditor protection for our surviving spouse. So this is a popular choice when a spouse passes away and we have our beneficiary designation filled out properly to do this spousal rollover and take advantage of this opportunity.
What happens if we get remarried what can I be assured that this money goes to my previous kids if I'm in a second marriage?
I've got a slide for that.
Aha.
This doesn't fit every situation. So there are disadvantages, and there may be times where we don't want our spouse to be named as the outright beneficiary. Pete, you mentioned the second point. Maybe we have a blended family. We don't want to allow our spouse to have the ability to change beneficiaries. Or, for example, we're worried that our spouse may not spend the money in the way and the manner that we wanted it to, and we want to put controls on the spouse. Naming a spouse as an outright beneficiary doesn't work for everybody, and in these situations, we wouldn't want to do that. Now, the second option is perhaps naming children, grandchildren, or other adult beneficiaries on our beneficiary designation form. That's another option. Now, the benefits, of course, is that if we have minor children and they are under the age of 21, then they would not be subject to this the Secure Act 10-year rule. I do want to say that it's a little bit confusing, this rule. What ends up happening is that if you have a child who is under the age of 21, they are considered an eligible designated beneficiary, not subject to the 10-year rule until they turn age 21, and then they're subject to the 10-year rule. So the farthest that this can get pushed out is just to age 31. But having said all that, we really don't want to name young children, particularly minors, as outright beneficiaries on these beneficiary designation forms because it causes all kinds of problems. Namely, if someone is under the age of 18, they don't have a signature. So we can't proceed without having to go to court and having a guardianship appointed. But as we'll see as we proceed on, we really don't want to name, even if we solve that problem, we don't really want our children and grandchildren to receive money, large sums of money when they're very young. Having said that, for our adult children or other adult beneficiaries, we can have them named here, and they will be subject to that, as I mentioned, 10-year secure rule, meaning that they have to empty the accounts within 10 years. And, that's not the end of the world. That's 10 years of potentially tax deferred growth. So that's great. And sometimes during that period, we work with our beneficiaries to manage the tax brackets. So you leave your account to your child. They are during that 10-year period, maybe 1 year they're not working, 1 year they have other tax things going on. It makes sense to take more out 1 year than another. And so we can try to manage the tax brackets during that 10-year period. Now, there are disadvantages, and I know this is Pete's favorite slide, is there can be problems with naming our children, even our adult children, as our outright beneficiaries on these retirement accounts. We've already discussed the fact that we don't want to name any minor children because they don't have signatures. But more importantly, our children may not be on the same page with us as far as pulling all the money out 7 days after you've passed away. As many of you know, this sometimes is the first money that becomes available to our children, and they are not cognizant of the tax issues that arise here. We could have irresponsible spending. It's surprising how many kitchens need to be remodeled 2 weeks after you've passed away, and this money can get pulled out. We can also have issues with children's creditors coming after the money. Do you want to throw any input in here, Pete?
Well, I want to ask you is that if you're, you do, besides doing the estate planning, you handle trust administration with for your clients, and are they aware that when their mom, dad, or someone dies, that are they surprised at the length of time that it takes to before they get the monies from their living trust?
That's right. The point you're making is that the trust may take longer to distribute, and this again could be the first money. And it's important that we counsel the children about the tax consequences of pulling the money out of these accounts. Again, not only losing the potential deferral, but all of
How
this.
long would it be? Let's say I died. How long would it be before my son could tap into my IRA?
Well, it takes about 7 to 10 days to get a death certificate, and as soon as you have the death certificate, it's open season.
Wow. So it's that quick.
Right. And what sometimes the beneficiaries' children don't understand is that this income, when they pull it out, gets put on the rest of their income for the year. So if the child it already made $100,000 and they pulled $250,000 out of an IRA, that gets them to $350,000 worth of income. And they may not figure out that they have a six-figure tax bill until April 15th of the following year.
Yeah. It happens very
Yep.
a lot.
So when we have a situation where we're worried about some of those issues, a trust sometimes can be the answer. And the IRS tells us in the hundreds of pages of regulations and rules that we can name a trust as a beneficiary of a retirement account. Now, the trust must meet certain IRS requirements and include special language that is all pursuant to these new regulations, final regulations under the Secure Act that came out in 2024. Now, the benefits of this, of course, is that when we name a trust, we can put someone else in control, and we provide, again, it can provide the control or the missing control of naming beneficiaries as an outright beneficiary. Now, we can also, using a trust, protect assets from courts, creditors, and irresponsible spending. And if it's done properly, we can also benefit our surviving spouse, children, or actually disabled individuals or chronically ill, or individuals that are not more than 10 years younger. In other words, that we can design it so that our eligible beneficiaries can still take a longer period than the 10 years that normally provided for. So a lot of interesting benefits, but it's not without its disadvantages. And this can get it pretty complicated and expensive. One of the national commentators is Natalie Choate, who writes a book called the Life and Death Planning of Retirement Accounts. And she says if you're going to go down the trust road, meaning having a trust as a beneficiary, you better have a compelling reason to do it. Some of the reasons she says that is because, of course, if you're going to do it for a spouse, we can't do that spousal rollover because a trust is not a spouse. The trust has to be carefully drafted to meet all the secure regulations. It is possible with this control could come higher tax brackets because the trust pays taxes at the higher rate sooner than individuals. It can be very administratively complex. You walk into Merrill Lynch or Charles Schwab and tell them that you are the trustee of a trust that's a beneficiary of an IRA account, and their head might spin around. And it can be very expensive to do proper planning in this area. And that's why, although this is an option, we better have a compelling reason to do it.
Very well said.
Thanks. Now, our fourth category is charity as a beneficiary. And sorry for the background noise, but it sounds like they're cutting the lawn in the back of my office. So we'll do our best here. Now, the fourth option is naming a charity as a beneficiary. And I've been talking all morning about how the IRS is going to get their share no matter what. Well, here's the way that we kind of beat the IRS at their game. Charities don't pay any income tax. So if we leave retirement account benefits to a charity, nobody pays the taxes. It is also possible that in certain strategies, we can reduce estate taxes by naming charity as a beneficiary. Now, issue that comes up is that when I see a new client, they generally have this whole thing reversed. What I mean by that is that they have named their children as beneficiaries of their retirement accounts, and they're doing their charitable giving under their trust account. And what that ends up happening is that we give I'm going to say the bad money to the children, that they all have the taxable money, and all of the good money from the trust that has already been taxed ends up going to the charity. And generally, in some of our planning, we want to flip that, right? We want the charitable gifting to potentially come from our retirement assets because, again, charities don't pay any income tax. Any comments on that one, Pete?
Yeah, we see it so often that individuals name the charities in their trust, and I don't think they realize they can do it in the IRA account. Let me ask you a question, Mike. Let's say, for instance, I want to give 10% of my estate or monies that I have to charity. Let's say I have a smaller amount let's say I have a smaller amount in my IRA account. In my trust, can I say, look to my IRA account first and then take the remainder from my trust?
Well, that sounds like a complicated way to do it. What we would have normally done is taken the beneficiary designation form, either by percentage or however we're going to achieve the client's goals, and fill out the beneficiary designation form so the IRA goes directly to the charity.
Okay.
Okay. And that leads into this. You don't have to have only one beneficiary. We could have multiple beneficiaries by percentage. You can also divide an IRA into different smaller IRAs. So there's lots of options here to do planning in picking beneficiaries for your retirement account. Now, we've talked about this Secure Act and how it is in essence going to force our beneficiaries in most cases to withdraw the money over a 10-year period, as I mentioned earlier, with the IRS being able to collect the tax on this money faster than we ever expected. So are there ways that we can respond to the Secure Act? And this is what this slide addresses. The first point is that, yes, it is only 10 years less than we could do before, but it is a 10-year period that does provide some significant deferral. During that 10-year period, again, we can manage the tax brackets to make it as most efficient tax-wise as possible during that 10-year period. Another way that clients potentially respond to this is doing something that I think was covered in last week. It is possible to create a charitable remainder trust and have your IRA pay to that charitable remainder trust, and in some instances can not only satisfy your charitable desires, but also create a longer period for our beneficiaries to get the income. Another option, clients have explored possibly buying some life insurance to pay what is going to be a lot of taxes over a 10-year period. So that's a possibility. Another possibility is doing what we call a Roth conversion, and that is converting regular accounts to Roths, which we're going to cover in a separate slide, but that's another way we could respond to the Secure Act. Another way, of course, is we don't have to worry about it if we're naming a charity as a beneficiary. Again, that solves the problem because charities don't pay income taxes. Another option is, charitably speaking, is we can use those QCDs during our lifetime to make charitable gifts to lower the amount of our retirement account. So that's an option. And the most important option is you could just spend it, right? Go on a cruise, get rid of the IRA.
Because, well, people save their entire life and they forget, that they can spend it. And not only that, but, sometimes their kids are in a higher income tax bracket.
That's right.
You
Well,
know?
and also it's really in some ways unfair. I have clients who spent 20, 30 years creating millions and millions of dollars in their retirement accounts. They expected to leave it to their children that they could stretch it over their lifetime, and the IRS, in some respect, pulled the plug or the rug out from under them, and now those children only have a 10-year period. So things have changed.
Yeah, I think your slide where it shows the actual percentage that they have to withdraw is really helpful uh, for individuals. That you're really taking a small percentage of your IRA when you take your required minimum distribution.
Agreed. Now, this next slide I want to cover are mistakes that I see my new clients, before I've helped them, have made on their beneficiary designation forms. So again, mistakes in filling out these, make sure you don't make these same mistakes. The first mistake, the most common mistake, is people leave them blank. They didn't fill out their beneficiary designation form, and that's a very difficult situation. What that normally means is probate. Without a beneficiary designation, if the account is large enough, we've got to probate the whole account. And so that's kind of a nightmare. The same result here, the same result if we write in the beneficiary designation form, my estate. That's also a problem because it doesn't have legal effect. My estate really means we're going back to probate to figure out where this IRA goes to. We already discussed when filling out the beneficiary form, we don't want to have minor beneficiaries. People do this with the best intention, but again, lots of problems naming minor beneficiaries. We also want to, when we fill out this beneficiary designation form, is we want to fill out both sections, what we call the primary and the contingent. The reason we want to fill out both sections is that unfortunately life doesn't always go as planned, and sometimes we've lost our primary beneficiary. Secondarily, we can do something we call post-mortem estate planning. So for example, let's say our primary beneficiary doesn't need the money or has other issues that they don't want to accept the money. They could maybe disclaim, what we call it, the money, and we could drop it down to contingent beneficiary. So there's even planning that can be done, but only if we filled out the form with lots of thought and both the primary and the contingent beneficiary has been completed. Another problem I see or mistake is not keeping beneficiary designations up to date. It isn't uncommon for me to meet a new client who has been married 3 times, and we've got a spouse from the first marriage named as a beneficiary. It's important. We want to keep these designations up to date. Also, it's important in my recommendation that you keep the records of your beneficiary designations. Again, when we work with our clients, we have them complete their designation forms for them and then have them make sure that they get a letter from the institution that holds their retirement account that it is on file, because we don't want to end up in a he said, she said, and I've had that case before. We want to make sure that the beneficiary designation, we have a record of it and it's confirmed. There's been a lot of mergers and acquisitions between banks and brokerage firms, and these forms have been lost in the past.
And most times when I sit down with a client and review their estate plans, they do not have their beneficiary designations forms with their wills, trust. It's in another part of the room or in a different file. Highly recommend that you keep those records with your estate planning documents. And that way, once if you review your documents, you'll remember, oh, this is the beneficiary that I named on those forms. And oh my gosh, the institution is no longer around.
Right.
I should update it. It's these beneficiary designation forms. You can't plead, oh, I didn't mean to sign it or I didn't mean to name this person. Is that correct, Mike?
That's right. Once you submit it, it's a contract.
Yeah, it's really important. And by the way, no matter whether it's a 457, 401k, 403b, all those plans, when money comes out of them, it's taxable as ordinary income. Are annuities, income from annuities, are they also ordinary income, Mike?
With the exception of what you put into the annuity, everything else is also what you're referring to is IRD, or income regarding a decedent, and it is all taxable as ordinary income.
So today, estate planning used to be about estate and gift taxes. And with the high level of exemption amount that to pay these taxes, income taxes are now the predominant issue because of annuities, of 401ks. Would you recommend that for most of us, if we have a 401k or a 403b or a 457 plan, should we roll those over into an IRA? And if so, why should we look at that alternative?
Well, the point you're raising is that after maybe perhaps you've retired or left your company and you're an existing 401k plan, on whether we want to leave it there or roll it over to an IRA. And although there are some extra creditor protections in the company plans, they are subject to a law called ERISA, a federal law. If we don't have any creditor problems that we're worried that someone's gonna pursue us, we like to recommend rolling over into an IRA for two main reasons. The first is that oftentimes in the ERISA company plans, there can be further restrictions on the planning that can be done because each company has a different plan. If you move it into an IRA, we have lots more flexibility and a standard plan that we're dealing with, so that can be beneficial. And the second is when you consolidate, it simplifies things, but it also opens up probably a larger universe of investing options. A lot of times the ERISA or company plans have a limitation on what can be invested and the family of funds that can be invested. When you roll that over to an IRA, it's pretty much limitless of what you can invest in.
We have a question from Steve regarding vocabulary. If I have an IRA account, we usually refer to that the beneficiary designation. What is a POD? Is the beneficiary designation form a POD, paid on death?
So there's just both of them are contracts to pay on death, but the difference is beneficiary designations are for retirement accounts and insurance, and PODs, payable on death, are used on non-retirement accounts. And so that's the distinction.
Thank you, Mike.
Okay.
And then is only the interest on annuities taxed at the ordinary income tax rates?
Anything, annuities don't only earn interest. So any of the growth beyond what you put in, what I'm going to call the principal. So whether that was dividends, interest, or anything else, when that excess comes out, it is all subject to ordinary income tax.
Yeah. In other words, all assets out of the IRA retirement planning accounts, annuities, receive a step up in basis. Is that correct?
That is not correct. So
okay, correct me, please.
Yeah. So unfortunately, things that are outside, things that are in the retirement accounts and so forth, they don't get any special step up, unlike other assets, meaning that the tax that is due will continue to be due. That's the IRD we were talking about. That is different than things like maybe your home or investments in your trust account. When you pass away, there's a special rule that says that the gains on all those things get erased and moved up, or quote unquote stepped up to the current value of your date of death. That rule doesn't work for retirement accounts and annuities.
Yeah. So that's why thinking of, if you're going to give to a charity at your upon death, take it from a IRD asset or from an IRA or annuity or something like that if you want the best tax benefits of it.
Agreed. All right, the last point is really what we've been talking about on this slide, is that don't make the mistake of not doing the planning for the income taxes when you're selecting beneficiaries. So that is exactly on point, because we do want to think about the taxes that are going to be owed.
Yeah, and that's, I just want to compliment you, Mike, because most estate planning attorneys do not go into just detail on the retirement of accounts because there's no documents really to draft.
Yeah, agreed. The next topic and our last topic are Roth IRA accounts, and I'll try to speed through this so we can leave some time for any questions at the end of the presentation. But the Roth IRA accounts, as I mentioned, have a different set of rules. So All morning, I've been talking about RMDs. Well, guess what? Roth accounts don't have RMDs, no required distributions during your lifetime. It doesn't matter when you turn 73, you're not required to take money out of it. You can continue to make contributions as long as you have earned income, regardless of your age, on these Roth accounts. And this is perhaps the most important topic or point, and that is that this money is not tax deferred. It is tax free, meaning that you and your beneficiaries will be able to withdraw money from these accounts and not pay taxes, including all of the earnings and growth on it.
I can't believe it's still around.
Yes, it's quite a deal. Now, they are subject after you've passed away to the 10-year rule, meaning that if we leave a Roth IRA to a beneficiary, although they don't have to pay taxes on it, they can't keep it tax-free forever. They have that 10-year limitation on them. You can do spousal rollovers, so lots of really neat options with these Roth IRAs. And you might be saying to yourself, well, I don't want my old retirement account. I want one of these fancy Roth IRAs instead. And the IRS has got you covered on that because they will allow you to do something called a Roth conversion. And what you can do is you can convert your traditional IRAs and other retirement accounts into Roths. There used to be some limitations about how much money you'd earned, but they took that away. Anybody can do a Roth conversion, but here's the catch, everybody. You got to pay the income tax on the conversion. So need to do careful analysis to see if this really makes sense. We're going to talk about some of those factors you might consider to do a Roth conversion in the next slide, but I wanted to mention that there used to be something we called recharacterization, where if you did this and then you didn't like the results, you could undo it all under what they called recharacterization. They took this away. So there is no more recharacterization. If you pull the trigger on a Roth conversion and you're not crazy about the results, you're stuck with the results. There's no going back. So again, important things to think about or factors to consider if you're thinking about taking one of your regular accounts or regular retirement accounts and converting it to a Roth. The first factor I would consider is that if you expect your tax rate to be higher in the future, maybe it makes sense to do some conversions now at the lower tax rate. By the way, you don't have to do, it's not all or nothing. You can do a little or as much as you want each year in these retirement accounts and convert them. You do also need to think about, in the second point, if that you're going to need this money for living expenses. We certainly don't want you to do this Roth conversion, pay the taxes, and then immediately have to withdraw the money out because you have to pay living expenses. And the same thing with your investment time horizon. We want to make sure that when we do this conversion, that there's enough time for you to grow this money in this tax-free environment to make all of this worthwhile. Now, this point right here, the fourth point, is the most important point. If you are going to do a Roth conversion, you have to be able to afford to pay the taxes from a different account, or what I call separate funds. Let me give you an example to illustrate what I mean. If you decide to take an IRA that has $100,000 of taxable money and convert it into a Roth IRA, and I'm going to say, let's say we have a $30,000 tax bill. We do not want $70,000 to end up in your new Roth IRA and you use some of the IRA money to pay the taxes. The math doesn't work on that. What we want to do is move the full $100,000 into the new Roth IRA and then using money from your trust account or your bank account and pay those taxes using separate funds. That's going to give you the head start that is important to make these numbers work. And the last objective or last point is you might be able to do some estate planning objectives by doing Roth conversions, estate taxes, and so forth. So those are some of the factors that you would want to think about if we are going to think about doing a Roth conversion. And the last slide I want to talk about regarding Roths is that you can think about perhaps jumpstarting your children, grandchildren, or another young person's retirement. If you're, in this example, if your child has earnings, maybe they work at Jersey Mike's or at the ice cream store and they've earned $7,000, which is the current maximum, they don't have to put their own $7,000 in. You can put it in for them as a gift and create a Roth account for them. That would mean that when they are 59 and a half, everything that you've put in there will all come out tax-free. If they're under 59 and a half, they can pull money out that was the principal contributions. If they decide they need to pull money out, they can pull money out for college and first home purchases. Another interesting rule is that if you have unused 529 funds, you can roll those over into a Roth account up to $35,000. So a pretty neat trick there. But remember that all of this is subject to that child or grandchild's control when they turn age 18. So use caution here. You might turn them into a millionaire, or they might buy a brand new car. So we have to be careful on that.
You know, human nature is such that we treat monies that are a gift different than money that is earned. But I love the idea because if you the child or has earned this money, and so they treat it differently than just if you just gave them a gift. And I would emphasize on this is that when you make that gift to the Roth IRA for your child, it's emphasized that they earned this money, and they'll treat it a little different than when they get to be 18, because most when can you own property here in California legally?
18. 18 is the age.
And what if you get money before you're 18? What happens?
Well, if it's an outright gift, for example, out of an IRA account or other gift directly, then the problem is that we might need to create something called a guardianship, where we have to go to court and have an adult appointed. Even if the surviving parent is alive, etc., we still have to control a guardianship. So it has to be carefully planned.
So grandchildren are just not a great idea to be named in an IRA account.
Not directly, that's correct.
Yeah. Okay.
Yeah.
Anyway, gosh, great program, Mike. Why don't you finish it up? Talk about this slide right here.
Well, just simply to wrap this up today, we really focused on only one component of a proper estate plan, meaning the retirement accounts. It's an important component, and hopefully after today you see how it fits in with the rest of your estate plan to make one successful plan. And with that, we've got a few minutes left, and I am happy to take questions that may be in the chat, or if you want to open up the Q&A, I'm happy to do it that too.
Yeah, we have a couple of questions in the Q&A. Well, I don't understand the question, but let me read it, and then Mike, you can see if you can go with the question. What does the 15-year minimum on an account age for a 529, what does that refer to?
So in the slide, again, this is in maybe perhaps setting up a retirement account, Roth account. There's a new provision that provides that you can take a 529 plan unused money and have that converted over into a Roth, and it does have to have existed for 15 years to take advantage of that.
Okay, great. And then Steve has a question. Can I open up a Roth account for my grandchild, use their Social Security number, but they can't assess it or access it, so they don't cash it out until my death?
Well, two points. First is that if it's a grandchild, we have to make sure that they have their own earned income for you to fund a Roth account. So that's important. We just can't make a gift. That grandchild has to have a job and earn some of the money. It doesn't have to be their money, but it doesn't have to be their money that goes into the Roth account, but they have to have earned income. And then the second part of this question is there a way that you could restrict it? And the answer is no. When they turn age 18, they're going to have access to it.
Yeah. What my mother-in-law did for our son was she had him work and do the yard, wash her car, clean the windows, basically work around the house. And then she filed a W-2 tax return for him, showing that he had earned income. And she would give him a partial cash out where the money's earned, but the majority of went into his Roth IRA account. And to this day, he's 38 years old today, and he still has that Roth IRA account, hasn't spent it. So earned income somehow is treated differently. Is there any other questions that we may have? Does anybody want to raise their hand and verbally ask a question? This is a very complex area, and most individuals do not give it a lot of thought, and they just name whom, what, how often do people just put, don't, what happens if you lose the beneficiary designation form? Company changes hands and they can't find one. What occurs?
Right. So that's the problem. And I also see this is related to a comment I also want to address in the Q&A. So we prefer clients fill out a paper beneficiary designation form. There's two reasons for that. One is that we can complete it for them, and we can also complete and add more detail that is unavailable to do it online, because you can fill these out online. Again, we prefer the paper version, more detail, and then once it's submitted, then what we want, to answer your question, Pete, is to get a written confirmation back that this has been put on file, and that's what we put in our estate planning binder to confirm it. So if we do have a consolidation or a change, that we are able to prove that we have it on file.
Yeah. One of the questions is that, do we go to a fee-only advisor or a broker to get the correct answers, or do we go to an estate planning attorney for the correct answers? I would say the estate planning attorney is your best bet, but most, again, estate planning attorneys don't get into this level of detail.
Well, and I'm going to sort of recommend a team approach, right? There are certain things the estate planning attorney does and certain things the financial planning attorney does. I think the question is about how to pick, and I guess my answer is that you're going to need both to be on your team, and then you're going to be assured of the best result.
And you also need to have a CPA involved, because you're looking at tax impact of withdrawal. So maybe in some years, you want to do over your required minimum distribution. Let's say you have a long-term care expense, and that gets deducted from under itemization under medical expense. That's well, right. Maybe in that particular year, your income, your adjusted gross income is going to be very low. So maybe you want to take out more monies out of your IRA in that particular year.
Or perhaps because you have the deductions for medical expenses, they can be used against your IRA.
Yeah. It takes a team. It's very not one person knows it all, and you need to crunch the numbers. It's not an exercise, for example, just to. I love the idea of a Roth conversion, I should do it. No, crunch the numbers and see what kind of impact it has on your finances, on your tax return. What is your goal in trying to do that? What kind of projection do you have in the future? It takes a little bit of a discussion and number crunching.